Welcome to the deep dive. Today, we're cutting through the noise to get to the core of a really intriguing business, one that deals with one of life's absolute undeniable certainties. We're embarking on a deep dive into Service Corporation International, or SCI, a company that operates right at the heart of the death care industry, managing those essential and, let's face it, often emotionally charged moments surrounding loss. Our mission today is to really unpack what makes this business tick, where its, colossal strengths truly lie, and perhaps more importantly, what surprising and significant challenges it faces. Think of this as your shortcut to truly understanding a company that, while maybe often overlooked in broader market discussions, is deeply embedded in the lives of millions. Okay, let's unpack this.
Precisely.
Yeah.
And this isn't just about crunching financial numbers on a spreadsheet, right? It's really about understanding the unique dynamics of an industry that intertwines business with, fundamental human experiences. We'll explore why SCI is often viewed as a fortress business in the investment world, almost, impervious to economic storms. But we'll also probe where that fortress might have some surprising vulnerabilities that the market often seems to miss. It's a fascinating study in economic durability versus, unseen risks.
So if you're curious about a business that literally deals with life and death and how that profound human experience translates into a remarkably durable economic engine and potentially an intriguing investment, then you are absolutely in the right place. Let's delve in. Okay, let's start with the absolute basics. For anyone maybe new to this company, what exactly is Service Corporation International, or SCI? And how does it actually generate revenue? Certainly not your typical tech company or consumer brand.
No, you're right. It's definitely not.
Yeah.
SCI is North America's largest provider of death care products and services. And when we say death care, we're talking about pretty much everything involved in funeral and cemetery services.
Yeah.
Their business model, at its core, is quite straightforward, but it has this unique twist that really sets it apart in terms of financial stability and long-term planning. It generates revenue from two main segments: funeral services and cemetery services.
Okay.
And interestingly, these two areas contribute almost equally to their overall revenue. It's roughly 56% from funeral homes and about 44% from cemeteries.
Pretty balanced then.
Yeah, that balance provides a stable and diversified operational structure, lessening their reliance on any single service type, which is smart. Now, within those two segments, the revenue flows from two distinct types of transactions, and they each have very different economic characteristics. First, we have what they call at-need services. These are the immediate arrangements that are made when a death actually occurs. And think about it in moments of profound grief. These services are inherently non-discretionary. Families need to make these arrangements right away. It's not something you can really put off or shop around for extensively.
Right, it's immediate.
Exactly. And this immediate essential need means that the typical price sensitivity you see in other consumer markets is significantly lower. Convenience, trust, the reputation of the provider, those become absolutely paramount. This gives established large-scale providers like SCI really remarkable pricing power. They've historically been able to increase prices on these services by an estimated 3% to 5% annually, year after year.
Wow, 3 to 5%.
Yeah, largely reflecting that inelastic demand.
Yeah.
It's a powerful position to be in, really.
That makes perfect sense. In such a vulnerable time, convenience and trust would definitely outweigh, a few $100s here or there. But you mentioned a second type of transaction that's really interesting. Tell us more about that one.
Right. This is where SCI's long-term strategy truly shines and what makes it such a, unique business model. Pre-need services. This involves selling funeral and cemetery products and services in advance of someone's passing.
Ah, okay. Planning ahead.
Exactly. And this isn't just a small side hustle for them. This strategic focus has allowed SCI to build an absolutely colossal, contractually guaranteed backlog of future revenue. We're talking approximately $16 billion in pre-booked services.
$16 billion with a B.
With a B, yeah. To put that in perspective, that's nearly 4 times their current annual revenue already locked in for the future.
That sounds like incredible foresight and stability. It's almost like a massive customer-funded, interest-free loan that they then get to deploy. How exactly does that work financially? That's just a staggering amount of future business already locked in.
You've hit on exactly the right insight there. It's not just foresight. It's a powerful financial flywheel that provides these really unique advantages. So when a pre-need contract is sold, the money is collected from the customer upfront. This capital, by law, is then placed into legally mandated trusts, often for many years, sometimes even decades, before the actual service needs to be delivered. The genius here is that these funds don't just sit idle. They are actively invested.
Ah, invested.
Yeah. And over those many years, the investment returns from these trusts actually compound. This compounding does two critical things for SCI. First, it helps to offset future inflation on the costs of delivering the service, essentially protecting their margins, even if their operational expenses rise significantly down the line.
Okay, so it keeps pace with costs.
Exactly. And second, it helps fund the perpetual maintenance of their cemeteries. Think about groundskeeping forever, basically. So you're absolutely right. It's a self-funding mechanism that smooths out earnings, provides immense liquidity, and enables management to engage in multi-decade capital planning. From an economic standpoint, this is vastly superior to simply waiting for at-need services to occur, because they're generating returns on capital that's effectively provided by the customer long before any service is rendered. It's a brilliant way to create durable, long-term value.
So it's a predictable business dealing with something none of us can avoid. Beyond this smart financial engineering with the pre-need stuff, what are the underlying deep-seated trends that make it so incredibly enduring? What gives it such a solid foundation?
Yeah, its endurance is deeply rooted in two really powerful long-term trends that are essentially irreversible, making it a truly unique kind of essential service. The first one is demographic certainty. The business is perfectly positioned to benefit from what we call the aging of America.
Old baby boomers.
Exactly. This isn't a guess or a projection. It's a well-documented and absolutely irreversible demographic wave. The number of Americans aged 65 and over is projected to increase substantially in the coming decades. And crucially, this isn't just a slow creep. A critical milestone approaches very soon, in 2026, when the first wave of that massive baby boomer generation turns 80.
80, that's significant.
It's a pivotal age where mortality rates significantly accelerate.
Yeah.
So this isn't just a gentle demographic shift. It's a structural, sustained tailwind for demand for deathcare services that will last for decades. It ensures a steady and indeed increasing volume of customers. The second trend is cultural constancy. While specific preferences certainly evolve over time, for instance, we've seen a really notable shift towards cremation from traditional burials. The fundamental human desires for memorialization, for gathering to grieve and celebrate a life, and for achieving a sense of closure remain absolutely constant across cultures and generations. Even during the unprecedented restrictions of the COVID-19 pandemic, when large gatherings were severely limited, families still sought ways to memorialize and celebrate their loved ones, maybe virtually sometimes, but the need was still there. As Thomas L. Ryan, their CEO, powerfully observed during that period, people still want to memorialize and to celebrate, which just underscores the deep-seated, almost primal cultural importance of these rituals that SCI provides. This isn't a fad. It's an intrinsic part of the human condition.
Given these powerful certainties, an aging population, and deeply ingrained cultural needs, many would argue a deathcare business like SCI is completely recession-proof. I mean, people pass away regardless of the stock market, right? Why might that seemingly obvious conclusion be a bit too simplistic when we really look at SCI?
That's an excellent challenge, and it really forces us to think beyond the surface. While it's true that death rates aren't correlated with economic activity, people unfortunately pass away regardless of GDP numbers.
Right.
And the core demand for their services is indeed counter-cyclical, or at least very stable. It's not entirely insulated from economic ups and downs.
Yeah.
Economic downturns can subtly influence consumer spending at the margin, which impacts SCI's revenue per service.
How so?
Well, for example, families facing financial hardship might opt for less expensive funeral packages, maybe choose more basic merchandise like a simpler casket or urn, or defer certain optional memorial events. They still need the core service, but they might not choose all the premium offerings.
Okay, trimming around the edges.
Exactly. And maybe more significantly, those crucial pre-need sales, which we just highlighted as a pillar of their long-term strategy, are a discretionary purchase made with future needs in mind. If people are worried about their jobs, their savings, or the overall economic outlook, then buying a funeral plan decades in advance might drop lower on their immediate priority list, you know?
Yeah, that makes sense. It's important, but maybe not urgent if money's tight.
Precisely. So while the base business, the at-need component, is remarkably secure and stable, its growth trajectory and its margin components do possess a degree of economic sensitivity that is sometimes overlooked in the recession-proof narrative.
Yeah.
It's remarkably resilient. Absolutely, but not entirely immune to broader economic tides. It's a key nuance to grasp.
You mentioned a fortress earlier. When I hear that, I think of something almost impenetrable, incredibly resilient against external threats. What are the specific competitive advantages, the moat, as they say, that truly protect SCI's business and allow it to thrive? How does it defend its leading market position?
You're right to think of it as a fortress, because SCI has built incredibly strong defenses. Their primary economic moat is really a formidable combination of two powerful elements. First, significant cost advantages derived from its unparalleled scale, and second, powerful intangible assets that come from its dense localized networks.
Scale and local presence.
Exactly. Consider this. As North America's largest death care provider, SCI operates over 1,900 funeral homes and cemeteries across the continent. This gives them a commanding market share of roughly 15–17%. Now, that might not sound huge, but it's in an industry that is, surprisingly, still incredibly fragmented. About 74% of operators are small, often family-owned independent businesses. SCI is the elephant in the room.
Right. So the big fish.
The very big fish. And this immense scale provides very clear, tangible benefits. They have superior purchasing power. Imagine a small local funeral home trying to buy caskets or embalming fluid they're paying retail, or maybe small volume wholesale prices at best. SCI, by consolidating demand across its vast network of nearly 2,000 locations, can negotiate much better prices from suppliers for essential goods like caskets, urns, and burial vaults. That's a fundamental cost advantage that small independent operators simply can't match.
Makes sense. Volume discounts.
Big time. And this is deeply complemented by significant operational efficiencies. They have centralized back-office functions for things like accounting, HR, legal services. They've invested heavily in a sophisticated, company-wide supply chain managed through modern procurement platforms. These shared resources, standardized processes, and deep expertise reduce their per-unit operating costs across their extensive network, giving them another durable cost advantage over competitors.
Okay.
And these scale advantages are further reinforced by those intangible assets I mentioned. Dense geographic clusters of locations. Think about it. If you have an SCI funeral home and an SCI cemetery conveniently located in a given city or suburb, you become the path of least resistance, just due to sheer proximity and familiarity. Plus, the ownership of perpetual care cemeteries, these are essentially assets with infinite lives, creates powerful high switching costs for families.
Right.
Once a family starts burying loved ones in a specific cemetery, they're kind of locked in for generations due to legacy and sentiment.
Right, that emotional connection.
Exactly. It's like owning land that consistently generates income with minimal ongoing effort once established. And families become very attached to that specific piece of ground.
That makes a lot of sense. The sheer size gives them buying power and efficiency. But can you give us a concrete, real-world example of this moat in action? How does this combination of scale and local density play out for a grieving family in real life, illustrating the power of that switching cost?
Absolutely. The combo location strategy is a perfect example of their moat in action, and it's really quite ingenious from a business perspective. As of 2021, SCI operated almost 300 such locations, where they integrate a funeral home and a cemetery on a single property or in very close proximity.
Okay, so everything's right there.
Everything's right there. Now, think about this scenario. When a family purchases a cemetery plot, what SCI calls an interment right, it's often a multi-generational decision. It's effectively an irreversible commitment for many families. That specific cemetery becomes their family's geographical and emotional anchor for memorialization for decades, maybe even centuries to come. Loved ones are buried there, and future family members often express a desire to be buried close by.
Yeah, keeping the family together, so to speak.
Precisely. This dynamic provides SCI with immense and long-lasting leverage. When a death later occurs within that family, the SCI-owned funeral home that's associated with that particular cemetery becomes the default, the most convenient, and frankly, the emotionally logical choice. Consider the switching cost here. Imagine the hassle, the time, the emotional energy of trying to coordinate an independent funeral director with an SCI-owned cemetery, navigating different contracts, different points of contact, different logistics, all during a period of intense grief.
Yeah, you just wouldn't want that extra stress.
Families simply don't want that added burden. This powerful lock-in effect secures future, high-margin funeral service sales, often years or even decades in advance, precisely when that cemetery plot is eventually used. This is precisely why reports suggest that SCI services, especially from these combo locations, can reportedly cost anywhere from 42% to 72% more than those of independent competitors.
Wow, that much more.
That's the power of the lock-in. It's a masterstroke in business strategy. They convert what might seem like a one-time property sale into a recurring, extremely high-margin service relationship. It's leveraging human emotion and convenience into powerful economic advantage.
So this fortress sounds incredibly strong, built on scale, network effect, and deeply embedded in human psychology. But no fortress is truly impregnable forever, right? Is SCI's moat getting stronger, or are there cracks appearing in its walls? What's the trajectory of this competitive advantage?
That's a critical question, and the assessment is nuanced. The most trajectory is generally assessed as stable, but it faces a significant and, I would argue, growing risk of narrowing over time.
Okay, stable but potentially narrowing. Why stable first?
Well, there's clear evidence for its stability. SCI continues to consolidate this highly fragmented industry through disciplined tuck-in acquisitions. These are smaller deals where they acquire existing independent funeral homes and cemeteries, which further enhances their scale advantages and market share in key local clusters.
So they keep getting bigger in key areas.
Exactly. And the scarcity of suitable land for new cemeteries, especially in dense urban and suburban areas, acts as a durable, long-term barrier to entry for any potential new competitors. It's incredibly difficult and expensive to just build a new cemetery from scratch these days. So, in many ways, it remains very robust. However, and this is a profound however, the primary pillar supporting this moat, its premium pricing power, is under direct structural threat from potential regulatory change that could fundamentally alter the industry's competitive landscape.
Ah, regulation. The big unknown sometimes.
A very big unknown here. The U.S. Federal Trade Commission, the FTC, is currently reviewing its long-standing funeral rule, which governs funeral home practices. And they are seriously considering mandating the online disclosure of prices by all funeral homes.
Online price lists, like for cars or hotels.
Exactly like that. SCI's entire economic model, which allows it to command those premium prices, relies heavily on the historical opacity of the industry and the low price sensitivity of grieving customers. Historically, they've resisted posting detailed price lists online. You usually had to call or visit. If the FTC implements mandatory online price transparency, it would empower consumers to easily compare prices for the first time, not just within a small local radius, but across a much wider competitive set right from their computer or phone.
That sounds like it could be a game changer.
A massive game changer. We've seen historical precedents, like in the UK, where a strikingly similar rule led to a dramatic collapse in the pricing power and profitability for the dominant player there, Dignity House.
Dignity House. Didn't you say they used to be part of SCI?
Ironically, yes, they were formerly part of SCI itself before its divestiture years ago. So the precedent is uncomfortably close to home. This isn't a temporary or cyclical risk that will just pass. It's a structural threat that could permanently impair the economic moat itself by fundamentally changing how consumers engage with and purchase death care services. It attacks the core of their premium pricing.
Okay, beyond the financials, the demographic tailwinds, and these looming regulatory threats, what's the word on the street? How do actual customers and the employees working there really feel about SCI? Is their polished public image matched by the ground-level experience, or is there maybe a disconnect?
This is truly where we uncover a fascinating and frankly pretty troubling dichotomy. If you only look at SCI's marketing materials and their flagship Dignity Memorial brand website, they're absolutely full of glowing testimonials, particularly from those who engaged in pre-planning. These customers consistently praise the peace of mind they got, the seamless process, the relief from burden that these arrangements provided to their families later on. It really paints a picture of compassionate, thoughtful, high-quality service, exactly what you'd hope for and expect from a leader in this very sensitive industry.
Sounds great on paper.
Sounds great on paper, but then you look at independent sources, and they paint a very different, far less favorable portrait. The Better Business Bureau, BBB profiles, for SCI's corporate headquarters frequently cite a pretty consistent pattern of customer complaints.
Oh, like what?
Well, these grievances often involve things like aggressive or misleading sales tactics, sometimes poor service quality, unexpected charges that seem to crop up after the fact, billing disputes, and even, in some cases, a failure to deliver on promised services or merchandise. Consumer advocacy groups have published extensive reports describing what they term anti-consumer practices, including those excessively high prices we talked about, and a general lack of transparency in the sales process, especially at the point of need. And on public forums like Reddit or various consumer review sites, the comparison of SCI to the Walmart of funeral homes is shockingly common.
Walmart. That's probably not a compliment in this context.
No, it's almost universally not meant as a compliment for value or efficiency. It's typically a criticism for being overly corporate, impersonal, and excessively profit-driven, which, understandably, feels deeply antithetical to compassionate care during such a vulnerable and emotional time for families. The overall impression you get from these sources is that customers often tolerate SCI for its vast network and convenience, especially if they're locked in by a pre-need contract or a combo location, rather than genuinely loving the brand for its value or the quality of its service. It feels more like a transaction than a relationship built on trust for many.
That's the stark contrast, really. So if that's how some customers perceive them, what about the people working within the organization? Do they feel like they're part of a mission-driven team dedicated to compassion? Or is there another side to that story, too, suggesting a different internal reality?
Yeah, the employee sentiment is similarly polarized, which suggests a pretty deep internal cultural divide within SCI itself. On one hand, you have many employees, especially those who've perhaps come from smaller, independent funeral homes previously, who genuinely praise SCI for its corporate structure.
Praise it. How so?
Well, they often highlight superior benefits packages, things like robust 401k matching, comprehensive health insurance, generous paid time off, even tuition reimbursement. These are benefits that smaller, often thinly resourced independent operators simply can't afford to provide. They also value the stability of timely paychecks, the clear career advancement opportunities within a large organization, and the potential for cross-training and relocation within the company's vast network. Some even find that the corporate scale can paradoxically provide a better work-life balance, for instance, by having dedicated teams for night calls, which frees individual directors from being on call 24/7, which is common in small firms. These employees often express a genuine commitment to the company's stated mission, saying their primary focus is truly to do right by the family. They seem proud of the service they provide.
Okay, so there's a positive side, definitely.
Definitely. However, there's also a significant and increasingly vocal contingent of current and former employees who describe a deeply toxic, high-pressure sales culture. They report that the environment is just relentlessly focused on meeting aggressive sales quotas and on upselling products and services, everything from elaborate caskets to more expensive memorial packages to grieving families, often at their most vulnerable moments.
Upselling grieving families. That sounds rough.
It sounds incredibly difficult. These individuals frequently report feeling severely underpaid for the emotional and physical demands of the job, describing the work as mentally draining and emotionally exhausting. They feel like they're just cogs in a factory line where profits over quality is the unwritten mantra, leading to high burnout rates and cynicism. Many also note a profound disconnect between the field locations where the actual service is delivered day to day and a distant corporate management team that appears to be interested primarily in financial metrics and not the realities of serving families with true compassion.
Is there any data to back that up beyond anecdotes?
Yeah, this negative sentiment isn't just anecdotal. It's quantified by data from Comparably, which is a workplace review site. It shows a strikingly low Employee Net Promoter Score, or ENPS, of -10 for SCI.
-10. That's really low.
It's a very poor score. And it indicates that a remarkable 47% of employee respondents are classified as detractors, meaning they would actively not recommend working at SCI to a friend. That points to a deeply troubled segment of their workforce.
Wow. So we have this clear, almost jarring disconnect between the public-facing image of compassionate service and this internal reality of what sounds like high-pressure sales for a lot of employees. What does this profound cultural dissonance mean for the business long-term? Is it just a sort of behind-the-scenes issue, or does it pose a genuine, maybe even existential threat to that fortress we've described?
I think this profound disconnect between the compassionate, service-oriented mission that SCI publicly talks about and the high-pressure, sales-driven environment described by a large number of its employees represents a significant latent risk to the long-term health and durability of the business. Ultimately, SCI's product is not merely merchandise like caskets and urns. It's fundamentally service, it's trust, and it's compassion delivered during a family's most vulnerable moments. That's what they're really selling.
Right, the experience and the trust.
Exactly. A corporate culture that incentivizes hitting aggressive sales targets and maximizing revenue per service at all costs is, by its very nature, fundamentally at odds with this core mission of empathetic care. This internal conflict and perceived misalignment can, and arguably does, directly lead to the negative customer experiences documented in those BBB complaints and consumer reports, which in turn directly damages the Dignity Memorial brand.
And the brand is key for pricing power.
Absolutely key. Over the long term, a tarnished brand simply cannot command premium pricing, especially in an industry so reliant on reputation and word of mouth. This directly erodes the economic moat that we discussed earlier, that ability to charge higher prices due to trust and convenience. While the company's current competitive position, its vast network, and its existing lock-in mechanisms may shield it from the immediate financial consequences of this cultural dissonance right now, it absolutely represents a crack in the fortress wall. This vulnerability could widen over time, especially if smaller, independent competitors who often emphasize their local, family-focused, and compassionate approach successfully market themselves as the more authentic alternative. It's a slow burn risk, perhaps, not an immediate explosion, but a deeply potent one that undermines the very foundation of their premium strategy. It suggests that while the financials might look strong today, a leading indicator of future trouble is already visible in how the company is perceived by those closest to it, its customers, and its own employees.
This has been a really fascinating look at the human and regulatory aspects. Let's shift gears a bit now and turn to the people actually at the helm. Who's leading SCI, and what's their philosophy when it comes to steering this very unique ship through these complex waters? Does their leadership seem aligned with the company's long-term strategy and creating shareholder value?
Yeah, the company is led by CEO Thomas L. Ryan, and he's had an exceptionally long tenure, which is increasingly rare in corporate America these days. He was appointed CEO way back in February 2005.
Wow, nearly 2 decades.
Exactly. That provides him with incredibly deep institutional knowledge of the business, its unique industry dynamics, its operational complexities. He knows this company inside out. An analysis of his public communications, particularly his shareholder letters and comments on earnings calls, reveals a clear, consistent, and remarkably stable operating philosophy that's really grounded in long-term value creation. He repeatedly emphasizes a disciplined, 3-pronged strategy. First, grow revenue steadily. Second, leverage their unparalleled scale to drive efficiencies. And third, wisely allocate capital to enhance shareholder value. It's a very pragmatic and financially oriented approach.
Seems straightforward.
Yeah.
Examples of that in action.
Well, his leadership during the unprecedented challenges of the COVID-19 pandemic provided a powerful case study in this enduring philosophy. Rather than focusing solely on short-term crisis management or just slashing costs, he consistently communicated a dual focus. On one hand, ensuring employee well-being and safety, which was critical, but simultaneously leveraging the crisis to accelerate long-term technological adaptations, particularly in digital engagement and remote service options, things that would benefit the company well beyond the pandemic itself.
So thinking long-term even in a crisis.
Exactly. It clearly showcases a mindset that prioritizes enduring strategic strength over just temporary results. And crucially, his financial interests appear powerfully aligned with those of long-term shareholders. He directly owns about 1.17% of the shares outstanding, a stake valued at roughly $136 million.
That's significant skin in the game.
Absolutely. While he does sell stock occasionally, as public filings show, this is pretty common and rational practice for a long-tenured executive diversifying their personal wealth over time. It's generally not interpreted as a negative signal on the company's future prospects. His wealth is clearly tied directly to the long-term success of SCI.
That's a significant stake, certainly aligning his interests with shareholders. So with all that robust cash flow the company consistently generates, how does management choose to use it? What's their approach to disciplined capital allocation? What are their priorities for that money?
Yeah, they have a clear, rational, and remarkably consistent capital allocation framework, which is really a hallmark of good management. The business generates robust and predictable cash flow, and the leadership team has been very disciplined in deploying this cash across a balanced set of priorities. For instance, the outlook for 2025 projects adjusted operating cash flow to be in the strong range of $830 million to $890 million. That's a lot of cash.
Definitely. Where does it go?
It doesn't just sit there. It's actively put to work in 3 main areas. First, there's substantial and ongoing reinvestment in the core business. They clearly recognize the importance of maintaining and enhancing their large portfolio of physical assets. For 2025, that includes approximately $130 million for capital improvements at existing funeral homes and cemeteries, keeping them modern and appealing. A further $160 million is allocated for the development of new cemetery property, which is essentially creating future inventory to serve that growing demographic demand.
Building for the future.
Building for the future. And another $25 million is earmarked for digital investments in corporate projects, improving their technological backbone and efficiency. This demonstrates a deep commitment to maintaining the quality and capacity of their asset base. Second, they focus on value-accretive acquisitions. SCI has a long and successful history of growth through disciplined tuck-in acquisitions.
Tuck-ins, meaning smaller ones.
Yeah, typically smaller deals where they acquire existing independent funeral homes and cemeteries that enhance their local network density, rather than huge transformative deals that might face antitrust scrutiny or major integration challenges. For example, in 2024 alone, they spent $181 million to acquire 26 funeral homes and 6 cemeteries. These acquisitions just deepen their moat in specific geographic areas. And third, they are exceptionally shareholder-friendly when it comes to returning capital directly to owners.
Dividends and buybacks.
Exactly. Since 2004, an impressive total of approximately $7.1 billion has been returned to shareholders through a combination of consistent dividends and aggressive share repurchases. The dividend is clearly a priority. It's been increased for 15 consecutive years. That's a very strong signal of management's confidence in future cash flows and their commitment to income investors.
15 years is a solid track record.
It really is. And they've also been an aggressive and consistent repurchaser of their own stock, reducing the outstanding share count by an average of 3.9% annually in recent years. That's a highly tax-efficient way of returning capital and boosting earnings per share for the remaining shareholders. This balanced approach to capital allocation, thoughtful division between internal reinvestment, external growth via M&A, and direct shareholder returns is truly the hallmark of a mature, disciplined, and shareholder-focused leadership team.
So the business makes a lot of money, and it seems management is very intentional about how they deploy it. That's definitely a good sign. But how strong is it financially truly when we look at the key quantitative metrics that analysts often dissect? Is it truly a financial fortress, or are there maybe hidden cracks in its balance sheet?
Yeah, SCI is indeed a remarkably reliable earnings machine. The non-discretionary and predictable nature of its services, coupled with its scale, has allowed the company to be consistently profitable for at least the last 10 consecutive years. That's a testament to the stability of its business model. Its operations consistently gush cash, which, as we just discussed, fuels its disciplined capital allocation. However, a quantitative analysis of key ratios reveals a crucial point, and sometimes a point of contention among financial analysts, which is definitely worth exploring in a bit more detail.
Okay, let's dig in.
Let's start with return on invested capital, ROIC. This is where it gets tricky, and it's a great example of how different methodologies can lead to vastly different conclusions about a company. Some reputable data providers calculate SCI's ROIC in the 11-12% range. Now, that's generally considered excellent and clearly indicates a high-quality, moat-protected business capable of consistently compounding shareholder value above its cost of capital.
Sounds great.
But then, other equally reputable sources show a much lower ROIC, sometimes down in the 4.3-5.6% range, which, if that were accurate, would imply value destruction and suggest a far less attractive business.
That ROIC discrepancy sounds like a pretty big deal. For listeners who might be scratching their heads at such a massive difference, what exactly are these different calculation methods missing or adding that makes such a monumental difference in SCI's apparent profitability and quality? Why is there such a wide range?
That's an excellent question, and it really speaks to the nuances of financial analysis, especially for unique business models like SCI's. The key difference lies almost entirely in how they account for that massive $16 billion pre-need backlog and its associated trust funds.
Ah, the trust funds again?
Exactly. The higher, more bullish ROIC calculation, which frankly we believe is more representative for assessing SCI's operational efficiency, likely excludes this customer-funded capital from the invested capital base in the denominator.
Why exclude it?
Because it's not capital that SCI itself had to raise or deploy from its own balance sheet to generate those future revenues. It's effectively customer money sitting in a trust. Earning returns for SCI, yes, but it's not part of their core operational capital investment in the business itself. This approach focuses only on the capital SCI itself, deployed for building or buying funeral homes, developing cemeteries, investing in operational infrastructure to generate its returns.
Okay, so it focuses on their capital.
Right. The lower ROIC calculations often include these large trust funds as part of invested capital, which significantly inflates the denominator, the ROIC ratio, and thus artificially suppresses the ROIC percentage, making the business appear much less profitable on its own capital than it likely is. So, our judgment, after careful consideration, is that its underlying economic ROIC is indeed probably in the low double digits, signifying a value-creating business that efficiently deploys its own capital.
Got it. That's a critical distinction. What about other metrics?
Next, let's look at free cash flow, FCF conversion. This is generally a strong positive indicator for SCI and is less prone to methodological debate. FCF conversion measures how effectively a company turns its accounting net income into actual spendable cash. A ratio consistently near or above 100% suggests that reported earnings are real and robustly backed by actual cash flow, not just accounting entries, and aren't being artificially inflated by aggressive accounting policies.
And SCI's number.
Based on trailing 12-month data, SCI's FCF conversion rate is exceptionally strong at approximately 122%.
Wow, over 100%.
Yeah, which means that reported profits are not only robustly backed by actual cash flow, but they might even be understated compared to the cash the business is truly generating. It really is a cash-gushing machine.
Okay, strong cash flow. What about the balance sheet? Debt levels?
Right. For balance sheet strength, we typically look at the net debt to EBITDA ratio. Management targets a ratio of 3.5x to 4.0x, which they view as an optimal level for efficiency given their stable cash flows. Currently, it's right in that target range, sitting around 3.6x to 3.7x. Is that high? Low? Manageable?
For a stable business like SCI with predictable cash flows, this level of debt is generally considered manageable and efficient. It allows for an enhanced return on equity for shareholders without taking on excessive risk. However, it's important to note that it's not what you'd call a fortress balance sheet in the most conservative sense, where you'd see virtually no debt.
So it has some leverage.
It definitely has some leverage. This level provides less of a cushion for a severe, unexpected structural shock to the business, such as that potential regulatory change we keep coming back to. And while its interest coverage is adequate, it's not exceptionally strong. So prudent? Yes, efficient perhaps, but not entirely bulletproof against a major, unforeseen event that drastically impacts their earnings potential. We've covered the business model, its impressive moat, the human element with customer and employee insights, and the leadership and financial fortitude. Now, for the critical question that always looms for investors, what's the current market price telling us about SCI's value? Is it a good investment opportunity right now for someone looking to put their capital to work?
Yeah, the million-dollar question, or perhaps $1 billion given SCI's size. When we look at SCI's current valuation multiples compared to its own historical trading range, the picture becomes pretty clear. The market is currently pricing SCI at a premium.
A premium? How much of one?
Well, its current price-to-earnings PE ratio is hovering around 22.3x to 22.7x. That's significantly higher than its 5-year average PE ratio, which was closer to 18.4x. So that represents roughly a 27% premium over its own recent history.
Okay, that's noticeable. What about cash flow? Similar story. The price-to-free cash flow PFCF ratio is also elevated at around 18.1x to 18.7x compared to where it's often traded. So, is it a compelling entry point today? Based on its high business quality, its undeniably durable moat, and its excellent shareholder-aligned management, the conclusion we reach is that the current stock price represents a fairly valued but not compellingly attractive entry point.
Fairly valued, not compellingly attractive. Break that down.
Okay. It's a high-quality asset, no doubt. It undeniably deserves to trade at a premium valuation compared to the average company, given its stability, predictability, and market leadership. However, the market has already widely recognized and priced in that quality. There's no significant secret left, no hidden gem aspect that the broader market hasn't already discovered and bid up the price for. And critically, the current valuation doesn't seem to incorporate a sufficient discount or margin of safety for the most significant long-term risk we discussed earlier. That potential for mandatory online price transparency from the FTC.
So the price doesn't reflect that risk adequately. It doesn't appear to. A truly attractive entry point for a long-term investor would demand a meaningful margin of safety against that specific structural risk, and that simply isn't present at today's price levels. So in essence, you're paying a fair price for what is arguably a wonderful company, but it's not a wonderful price that provides a compelling asymmetric risk-reward for deploying new capital today.
That distinction between a wonderful company and a wonderful price is absolutely key for any investor, definitely. So looking ahead then, what are the primary growth engines that SCI will rely on for future expansion? And maybe let's reiterate those major, truly long-term risks that could permanently damage this business model or its earning power. What could fundamentally change the game for them down the road?
Right. The single most important and undeniable growth driver is that inevitable demographic trend of an aging North American population. The massive baby boomer generation, numbering over 70 million people, is now entering their 70s and 80s, which will mathematically lead to a sustained multi-decade increase in the absolute number of deaths per year.
Just more volume.
Just more volume. It provides a powerful and highly predictable tailwind for volume growth across both the funeral and cemetery segments of the business. Management has explicitly stated its expectation to return to its long-term adjusted EPS growth framework of 8% to 12% annually, beginning in 2025. And that growth is expected to be driven by this demographic tailwind, combined with their continued pricing power, assuming it holds, operational leverage from their scale, and those disciplined tuck-in acquisitions. More people dying simply means more potential customers for SCI.
Okay, that's the main growth story. What about the big risks?
However, there are 3 genuine long-term risks that could permanently impair SCI's earning power and should really give any potential investor pause. First, and we've emphasized this because it is so significant, is regulatory forced price transparency. An updated FTC funeral rule mandating clear online price lists could permanently attack SCI's core pricing power, triggering intense price competition and structural margin compression across the entire industry. The UK precedent, where a similar rule devastated profitability for the dominant player, serves as a stark and I think largely ignored warning of just how impactful this can be. If people can easily compare prices, SCI's 40-70% premium is suddenly very exposed.
Okay, FTC rule is number 1. What else?
Second is changing consumer preferences, particularly the persistent ongoing shift away from higher revenue traditional burials towards lower cost, lower margin cremations. This trend has been in motion for decades now and shows no sign of reversing. While SCI actively tries to upsell cremation customers with things like memorialization services and the sale of cemetery property for cremated remains, like niches, the core cremation service itself simply generates less revenue and often lower profit margins compared to traditional burials. This is a persistent structural headwind that they constantly have to fight against.
Right, the cremation trend continues. And the third risk?
And third, reputational erosion. The documented pattern of customer complaints and negative employee reviews regarding those high-pressure sales tactics and a perceived profit-focused culture poses a genuine long-term risk to the Dignity Memorial brand itself. In an industry built fundamentally on trust, empathy, and compassion, eroding public perception could severely weaken customer loyalty and ultimately undermine its premium pricing strategy, even in the absence of direct regulatory intervention. If that Walmart of funeral homes perception takes hold more broadly, their ability to command premium prices is fundamentally compromised. These are not minor headwinds. These are potential structural shifts that could change the very economics of the business.
So after this really deep dive, how does this detailed picture we've painted compare to what the broader market generally believes about SCI? Is there a significant disconnect between the sort of consensus view and our more granular analysis here?
Oh, there absolutely is a significant disconnect, I think. The prevailing market consensus, if you look at analyst ratings and general commentary, is that SCI is a stable, high-quality, almost classic buy-and-hold investment. It's almost universally seen as the clear industry leader, perfectly positioned to benefit from that undeniable demographic tailwind of an aging population, and guided by shareholder-friendly management that consistently returns capital. It ticks a lot of boxes for conservative investors.
Sounds like a pretty positive consensus.
Very positive. And this view is reflected in the consensus strong buy ratings from many Wall Street analysts and, as we discussed, the premium valuation multiples at which the stock currently trades. Essentially, the market sees the stability, it sees the predictability of the business, it sees the clear demographic opportunity, and it is very much willing to pay up for that perceived certainty. It's often viewed as a kind of safe harbor stock in uncertain times.
Okay, so the market likes it. How does our analysis differ?
Well, this analysis differs significantly by placing a much, much heavier weight on 2 interconnected factors that the market appears to be profoundly underestimating or, frankly, maybe even ignoring altogether. First, the market seems to be discounting both the probability and, perhaps more importantly, the potential impact of forced price transparency via that FTC rule change. The possibility of an updated funeral rule is viewed, if it's viewed at all, as kind of a low probability, low impact event. The thinking seems to be, oh, it's been talked about for years, it won't actually happen. Or if it does, it won't matter much.
In complacency, maybe?
Perhaps. This analysis, however, views it as a medium probability, but extremely high impact event. And with UK precedent serving as a stark, clear warning that the market seems content to just overlook, they seem to be whistling past the graveyard, quite literally in this case.
Okay, underestimating the FTC risk. What's the second factor?
Second, the market looks at SCI's stellar historical financial performance, the consistent profits, the strong cash flow, as definitive proof of enduring quality and a robust moat. The numbers look great, right? This analysis, however, posits that those financials, while impressive in isolation, are fundamentally a lagging indicator of business health. They tell you what has already happened.
Right, looking in the rearview mirror.
Exactly. The scuttlebutt we gathered from customer and employee sentiment, those complaints about aggressive sales, the feeling of being cogs in a machine, the negative brand perception potentially brewing that's arguably a leading indicator of potential future problems. The company's powerful moat, its scale, and its existing lock-ins currently allow it to post excellent financial results despite these underlying cultural and service issues. It's like a heavily armored tank that still looks formidable on the outside. But a fundamental change in the competitive environment, like that forced price transparency, could cause the lagging financial performance to rapidly catch down to this underlying ground-level reality.
So, if I'm hearing you correctly, the market sees a fortress, seemingly impenetrable and built to last, but our analysis suggests it's a fortress with a potentially fatal, yet-to-be-exploited vulnerability. It's like they're admiring the impressive walls, but maybe ignoring a fault line running right beneath its foundation that a significant tremor like the FTC rule change could suddenly activate.
That's a perfect analogy. Exactly. The consensus view focuses predominantly on the demographic tailwind, the simple fact that more customers will mean more business. More volume equals more profit. Our second-level analysis, however, focuses less on just more customers and far more on the profitability per customer. The benefit of simply having more customers could be completely offset or even overwhelmingly negated by a significant and permanent drop in the price they can charge and, consequently, their profit margins. The market is pricing the stock today based on the confident assumption of the continuation of its historical pricing power, assuming business as usual carries on indefinitely. But there's a non-trivial probability that this very pricing power, the ability to charge that significant premium, could be structurally broken within the next 5 to 10 years. In essence, the market is pricing in the demographic opportunity, which is undeniably real and positive, but it seems to be failing to adequately price in the existential regulatory threat that looms large over its core pricing strategy. It's a classic case, perhaps, of focusing on the obvious positive while underappreciating the more nuanced but potentially devastating negative.
Okay, let's try to synthesize all of this now. For anyone weighing an investment in SCI, perhaps listening to this deep dive, if someone were to argue strongly for owning it in their portfolio, what are their main, most compelling points? What's the best bull case for SCI today?
The bull case for SCI is actually very strong on several fronts, and you can see why it's a favorite among many institutional investors and conservative portfolios. You'd highlight its unmatched scale in a truly predictable industry with largely non-discretionary demand, perfectly poised for undeniable long-term volume growth from that aging North American population. This demographic certainty provides a powerful multi-decade tailwind. Then there's the durable economic moat, which is built on those dense local networks and incredibly high switching costs, particularly from its strategically valuable combo locations where the funeral homes and cemeteries are integrated. This integration grants them substantial, durable pricing power, at least historically. Furthermore, the business generates exceptional and highly consistent free cash flow, especially boosted by that immense pre-need segment. And this cash is deployed very effectively by a long-tenured, clearly owner-aligned management team through a very rational and balanced program of internal reinvestment, disciplined acquisitions, and substantial capital returns directly to shareholders via dividends and buybacks. And finally, you absolutely have to mention that massive, locked-in $16 billion pre-need revenue backlog. It provides unparalleled visibility into future earnings and financial stability, essentially smoothing out earnings and insulating the business from much of the typical economic volatility you see elsewhere. It looks like a compounding machine in a necessary industry. Okay, that's a compelling bull case. Now, what's the strongest argument against it? The bear side, the counter thesis that says, hold on a minute, this isn't as good or as safe as it looks, and there are serious risks lurking here. The bear case really centers predominantly on that existential threat from regulatory change, specifically the potential for the U.S. Federal Trade Commission to mandate online price transparency. This single change could severely and permanently impair SCI's premium pricing model, triggering intense price competition across the industry and leading to significant structural margin compression. It's the biggest single risk by far. Beyond that, there's the persistent negative customer and employee sentiment we discussed. That documented pattern of complaints and internal cultural issues risks the long-term erosion of the Dignity Memorial brand, which is absolutely crucial in an industry built so heavily on trust and reputation. Furthermore, the current premium valuation, as we noted, offers essentially no margin of safety against these significant long-term risks. You're simply paying too much for the perceived quality without adequately factoring in these looming threats. And finally, while currently manageable, the company's leveraged balance sheet provides relatively limited cushion against a severe structural shock to its profitability. If those margins were to collapse due to price transparency, the existing debt could quickly become a significant problem rather than an efficient tool.
Let's take that bear case to its most extreme then. For our listeners who are really digging deep into this, trying to stress test the idea, what's the single most compelling argument for why an investment in SCI today could prove to be a major long-term mistake for someone buying shares at current levels? What's the red team challenge that truly flips the script and highlights the potential downside?
I think the most compelling argument, the one that should keep a potential investor up at night, is the argument that we are effectively buying this company at the absolute peak of its pricing power, just before that power is potentially permanently broken by regulation. Let's invert the bull case for a moment. What if that undeniable demographic tailwind, while absolutely real, is actually a red herring, distracting from the real risk? The bull case assumes more customers will automatically translate directly into higher profits because they implicitly assume the current pricing power remains intact.
Okay, so the volume isn't the whole story.
Not if the price per customer collapses. But if the FTC does mandate online price disclosure, this is what could plausibly happen, and it's not pretty. For the first time, consumers will be able to easily and, importantly, unemotionally comparison shop for funeral services online, maybe even from their smartphones, while sitting with family making arrangements. In doing so, they will quickly discover the well-documented 40% to 70% price premium that SCI often charges over local, independent competitors for similar services. Price will rapidly become a much more significant factor in the consumer's decision-making process, eroding the loyalty that was previously based largely on convenience, proximity, and a fundamental lack of readily available pricing information.
Price becomes visible, so it matters more.
It's exactly. To remain competitive and prevent significant volume loss to lower-priced independents, SCI would likely be forced to lower its prices substantially, perhaps by 20% to 30%, mirroring what happened to Dignity Black in the UK after similar regulations were imposed there. Now, given SCI's business model with its high degree of operating leverage and significant fixed costs, their extensive network of properties, their large staff, cemetery maintenance, this sharp decline in revenue would not be matched by a proportional decline in costs. You can't easily cut those fixed costs.
Margins get squeezed hard.
Squeezed. More like crushed. It would likely lead to a catastrophic collapse in operating margins and consequently a dramatic fall in earnings per share. In that scenario, the company's current leverage ratio of around 3.6x net debt EBITDA, which looks manageable in today's stable earnings environment, would suddenly become crushing in a scenario of permanently lower EBITDA. This could potentially trigger debt covenant issues, force the company into a defensive, value-destructive posture, maybe selling off assets at fire sale prices, slashing the dividend, halting buybacks. An investor buying today would, in this scenario, be buying into a business whose fundamental economics are potentially on the precipice of changing for the worse, permanently. The decades of success that were built upon an opaque pricing environment would come to an abrupt end, and the stock would inevitably derate significantly to reflect this new, lower margin, more competitive reality. That, I think, is the single most potent argument for why this seemingly wonderful company could become a terrible investment from today's entry point, buying at the peak just before the fall. #outro.
So you've heard the deep dive into Service Corporation International. It's a truly fascinating look, isn't it? A company built on life's ultimate certainty with really powerful strengths from its scale and that groundbreaking pre-need strategy, but also, as we've explored, some significant vulnerabilities, particularly from potential regulatory changes and those internal cultural dynamics that could eventually erode its brand.
Indeed. A stark reminder, I think, that even in seemingly stable, predictable industries, disruptive forces, especially regulatory ones, can completely reshape the competitive landscape in ways that are often hard to foresee until they are right upon us. Mm-hmm. What stands out most to you from this deep dive into SCI's world?
For me, it's really that profound tension between that undeniable demographic tailwind, which feels like such a sure thing for future growth, such an easy story to buy into, and the very real lurking risk of a structural shift in pricing power. It's a powerful lesson in looking beyond just the obvious, widely accepted trends that everyone else is focused on. The obvious isn't always the full story, is it?
Absolutely not. And this raises a broader, important question for any investor or just any curious mind assessing any business that looks like a fortress. Are we adequately considering the leading indicators, things like customer and employee sentiment, alongside the lagging financial performance? And perhaps more importantly, how much of a margin of safety do we demand, should we demand, for structural yet to be realized risks that could permanently alter a company's competitive advantage? It's really about trying to spot those subtle tremors before the earthquake hits, isn't it?
Absolutely. Definitely something to chew on long after our conversation ends. We hope this deep dive has given you a valuable shortcut to being well informed about a truly unique and complex business. Join us next time for another deep dive.